Quick question for you guys. Can you really build wealth in the stock market with just 500 rupees a month? Most people think you need lakhs of rupees to invest, but that's not true. With mutual funds, even 500 rupees can be spread across dozens of India's top companies. Today, I'll break down mutual funds, what they are, how they work, the risks, the fees, and how normal investors like us can use them to grow their wealth. By the end of this video, you will understand mutual funds better than most people who already invest in them. Imagine this. You have 5,000 rupees in your bank account. You want to invest in stocks, maybe Infosys, HDFC or Reliance. But here's the problem. You can probably just buy one or two shares. And if that company tanks, your money is just gone. The real question is, how do small investors like you and me diversify without needing huge capital? And that's where mutual funds come in. Think of mutual funds like a food adventure with friends. If you try 20 restaurants alone, it's too expensive. But if 10 friends pool money, everyone gets to taste everything. A mutual fund works the same way. Instead of you buying one or two stocks, the fund collects money from lakhs of investors and invests it across 30, 50 or even 100 companies. So your 5,000 rupees is spread out. If one stock fails, your investment is still protected by the other stocks. When you invest in a mutual fund, you're not buying shares, you're buying units. Here is how. Suppose a fund manages 100 crore rupees. That's called asset under management or AUM. It's divided into 10 crore units. So each unit is worth 10 rupees. This is called as NAV or net asset value. If the companies inside do well and the AUM grows to 120 crores, the NAV becomes 12 rupees. If you own 500 units, your 5,000 grows to 6,000 rupees. And that's how returns are generated. But who decides where the money goes? That's the job of a fund manager, a professional who researches, buys and sells stocks. Of course, they charge a fee called as expense ratio. For actively managed equity funds, this is usually around 0.1 to 1.5% per year. For index funds, which just copy Nifty 50 or Sensex, costs are much lower, 0.1 to 0.3%. But here's the catch. It's deducted daily from the NAV. You never see the bill, but it's always being taken out quietly. Not all mutual funds are the same. Just like restaurants have different menus, funds have categories. First is equity funds. Equity funds invest in stocks, high risk, high growth potential. Debt funds invest in government bonds or corporate debt, safer but lower returns. Next is hybrid funds. They are a mix of equity and debt. And next we have is index funds. They basically copy the market index. They are simple, low cost and very popular. Even within equity funds, there are different flavors. Large cap funds invest in India's top 100 companies, stable but slower growth. Mid cap funds invest in the next 150 companies, riskier but faster growth potential. Next is small cap funds. Small cap funds go after the small businesses. They can give huge returns, but they're very volatile. Now let's talk about what everyone cares about. Returns. Historically, Indian equity mutual funds have delivered about 10 to 12% returns annually over the long term. Debt funds usually give 5 to 7% of returns. But here's the truth. Returns are not guaranteed. If markets fall, your NAV falls too. That's why your time horizon matters. If you need money in 6 months, don't invest in the equity funds. But if you're investing for 5 to 10 years, mutual funds can create real wealth for you. Now let's talk about one of the smartest ways to invest your money. SIPs, or called as systematic investment plans. Instead of putting 1 lakh rupees at once, you invest small amounts every month like 500 or 1000 rupees. Now this does two things. One, it averages out your market's ups and downs, called as rupee cost averaging. Two, it builds the habit of investing regularly. Over time, SIPs can grow into significant amounts thanks to the power of compounding. One more thing, people often miss exit load. Some funds charge you a small penalty if you withdraw too soon, usually 1% if you redeem within a year. So always read the scheme documents. Check the expense ratio, exit load, fund manager, their portfolio. Don't just pick a fund because your friend said so. In short, mutual funds are like a shortcut to investing in the stock market. They give you, first is diversification. Your money is spread across many companies. Second is professional management. Experts make a decision for you. And third is accessibility. You can start with as little as 100 or 500 through SIPs. Next is liquidity. You can withdraw when you want, unlike fixed deposit. And that's why they're often called the easiest way for beginners to start investing. So next time someone says mutual funds sahi hai, you will know exactly why. But remember, not all funds are equal. Always do your research, compare expense ratios, and invest with your goals in mind. And if you found this video helpful, drop a like and a comment. And if you want to see more such videos, go subscribe to Discover AI right now. And I will see you in the next video, guys.